From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello. Welcome to the COB on this Friday afternoon. I'm Nadine Blaney. I'm all on my own today, just until I'm joined by my special guest, Shane Oliver, AMP Capital Chief Economist. Big week. It looks as if the local market, though, will end slightly into negative territory over the 5 trading days. Today was really no help, as you can see, selling into the close for the CBO Australia Index, and we are taking a look at the S&P ASX 200 down by close to 0.7%. Week to date, as the final trades go through, down by about 0.2%. Pretty negative for the some of those markets, including the Nikkei, down by more than 1%, although quite a different story for Chinese mainland markets. I had a really interesting chat with a gentleman just in the hour previously, and it was a chat about emerging markets versus developed markets, and I gave some perspective when it comes to what we could potentially expect from a Trump presidency and what's already priced into the market. That was Navin Hingorani from East Spring Investments. You might like to go and have a little listen. When we are talking about what happened today, though, I mean, a lot of it comes down to that just funk, and I think it's ahead of the jobs read that's coming in the United States today. So not a whole lot of reason for Aussie investors to take on a lot of risk going into the weekend. Of course, it was sort of 2 steps forward, 1 step back throughout the week, which is a pattern that we've sort of been going through lately. Obviously, Bitcoin reaching 6 digits was a big talking point, but we'll get some assessments of what we could see coming through in that jobs report. And don't forget as well that we're looking forward to the RBA's decision that gets handed down on Tuesday, 2:30 p.m. You'll want to join us on AusBiz for live coverage when that happens. And we had Iluka absolutely crashing down to earth. It looks so promising, when you hear that it's getting government money to help progress a project that obviously has been identified as the Australia Future Made project to really identify critical minerals and how we can support local industry. But clearly wasn't enough for the market. It was the worst performer last time I checked. As far as some of the broader sectors go, a little bit of a mixed picture being painted here with the ASX big miners, so BHP, moderately higher. We had some news from Rio Tinto yesterday on its copper outlook. Safe to say that we had 10 out of 11 sectors negative today. And so that included retailers, or energy, I should say. So OPEC plus delaying a decision to increase supply. Still not enough to help some of these companies push forward. There are some concerns about demand, obviously, around parts of the world, including China. Mixed picture here, but consumer staples and discretionary retailers did come under pressure. Both those sectors were lower overall. One of the winners today was APA. The energy regulator confirmed it would not subject its South West Queensland gas pipeline to full price regulation. Minor story, but Macquarie's Corio Generation plans to cut a small number of jobs. Aristocrat shares fell after its chief executive, Hector Fernandez, announced his resignation late yesterday to join Apollo Global. And there is Iluka. So $214 million cash contribution to cover a cost blowout at its domestic rare earths refinery. And the company did say that it would update the market on that further in February, so perhaps a little bit of a news vacuum until then. Welcome to the COB, Shane Oliver from AMP. Shane, welcome. It doesn't look as if we'll be putting any positivity on the boards over the 5 trading days this week. What went wrong?
That's a good question. At various points today, the market was basically flat for the week. I think there's a couple of things that have worked against the market. We did make record highs last week, and at points through this week we did as well. The problem is that we did see those very soft GDP numbers in the middle of the week, so that was a bit of a drag. As you mentioned earlier, I think there is uncertainty ahead of the payroll figures tonight. So Australian investors, at the margin anyway, not prepared to take on risk ahead of that. And I guess to some degree, working the other way is expectations that maybe the Reserve Bank will cut a little bit earlier than had been thought. The consensus had moved to May. Maybe now it's possible they might get a cut in February. That should be a bit of a positive. So in the great scheme of things, the market didn't have that big a move. It's also worth noting that even though December is traditionally a seasonally strong month, that seasonally positiveness often doesn't start until the last 2 weeks of December, when Santa arrives, and you get the so-called Santa rally, which is often in the run-up to Christmas and between Christmas and New Year, that period. So the first week or two of December can be a bit sort of so-so ahead of that seasonal strength. So I wouldn't necessarily read too much into it. We have still hit record highs. In the great scheme of things, we're only a little bit off the high, only down slightly for the week.
Yeah, it's not bad. It's not bad. And I take your point that we did hit record highs at times. But I guess, I mean, how concerned are you about valuations in some sector of even this local market, tech, for example?
Like, it has to be seen as a concern. The Aussie share market's trading, I think, on a forward PE of around 21 times. US shares trading on about 26 times. That's quite high historically. The norm used to be something like 15 times in Australia. So we are somewhat stretched on valuations. Market is very vulnerable if bond yields continue to rise and if earnings don't start to recover. But of course, that is the way out for the market. If you start to see bond yields head down more decisively, they have come down a little bit over the last couple of weeks from their recent highs. And that continues into next year. That will take a little bit of pressure off. And likewise, if we see stronger earnings in our market over the next 12 months, which I think we probably will start to see on the back of a very gradual pickup in economic conditions. We saw in the GDP numbers that GDP growth did pick up from the prior quarters, but it was only from 0.2 to 0.3, so there's not a lot in it. But it may gather a little bit of steam as we go through the year ahead. And so that negativity we're seeing in per capita GDP, as shown in the chart there, should start to sort of wane a little bit as we go through next year. I think many would be hoping, it's certainly hoping that it does. So those things I think will help the market, but there is still a risk there. You know, when you've got valuations at these sorts of levels, when the bond earnings yield gap is unattractive for shares, as it currently is, particularly so in the US to a lesser degree in Australia, that does mean there is a degree of risk around the markets. And so you can't rule out a correction at some point. And I think through next year, we will see far bigger corrections than we've seen this year. This year, I think the worst the US market had top to bottom was about a 10% fall. In Australia, it's been a lot less than that. It's been a relatively calm year in the great scheme of things. Next year, I think we're going to see a lot more volatility. It wouldn't surprise me at all if we see a 15% correction along the way. But by the same token, if earnings pick up, central banks cut rates, including the RBA, that'll provide support for markets. So in a big picture sense, I'm not overly concerned, but it's certainly a risk.
Well, but I did see your forecast come out this week, Shane. I read your notes, all of them, of 8,800 for the S&P ASX 200 2025. I mean, that's not that far away from where we are now.
No, that partly reflects my caution on the valuations. I think when I wrote that, I was going from a base of about 8,500, and I assumed about a 3.5% uplift in the market, and then the total return of 7% I'm talking about includes a dividend yield of 3.5%. So it is quite cautious. I think so far this year, the market has had a 12% capital gain or thereabouts, depending on which day you look at, 11, 12%. But next year, I think you have to allow that it's going to be a lot slower. For one thing, the US share market has had another year of super duper double-digit returns, 20% plus. I think 25% year-to-date global shares have returned in total, something like 25% year-to-date with dividends. That is simply unsustainable. Trees don't grow to the sky. There is a limit to this. And I suspect that next year we'll see a lot more restraint around, more volatility and more constrained return. So that's why I'm only assuming capital growth of around 3.5% as we go through the course of this year. And you're right, yes, it's not that far away. But I think for an investor, if you're in a world of, say, 2 to 3% inflation and you're getting 7% out of Australian shares, add in the franking credits, that takes that to 8%. That's still a pretty good real return in the great scheme of things. I wouldn't be too concerned about that if I was an investor. You just have to be realistic. not going to be double digits. It's not going to be 20% plus indefinitely.
One of the big stories from this week was Bitcoin smashing through that 100,000 psychological barrier. But I also thought it was interesting, just Jerome Powell, the Fed chair's comments around a crypto, which, some say fueled that rally, talking about it just as a matter of fact, that it is virtual, it is digital, not using it as a form of payment or store of value, not a competitor for the dollar, but really a competitor for gold, he said.
Well, I would agree. It's being seen as digital gold. It has effectively ruled itself out as being a transactional currency. Bitcoin has basically said, we don't want to make it easier for people to use it for transactions. We want to preserve the integrity of it, much like gold is not used in transactions. So that's, just on that chart there you flashed up, I think it is just worth pointing out that we are seeing fantastic gains. I know everyone gets really excited when it goes through 100,000. The high back in March was 73,000, so we're doing really well. Just worth bearing in mind that if you track each of the highs, the one back in 2011 and then compare it to the one in 2013 and then the one in 2017, which I've done on that chart there, or just look at the lows, that the pace of gains from each high to each high to each low is slowing down dramatically. A lot of the easy gains have been had. That said, even if you see a slowdown this time around and the Bitcoin price goes up, say, 2 times from its 2021 high, that'll get you to 135,000.
Yeah.
If it goes up 3 times, so it's still slower than what we saw in the last cycle, which was a 4 times uplift. Even if it goes up 3 times, you get to 200,000. So there's still more upside there. It's just that people jumping onto it now have to realise a lot of the easy gains have been had. You're not going to get the same phenomenal returns. But I think basically Bitcoin is eating gold's lunch. It's taking money that otherwise would have gone to gold. There's always a pool of people out there who are distrustful of paper currencies, think the government's going to confiscate the money from them in one way or another, either from their bank accounts or via inflation, and therefore they went to gold. These days, you've got another option. It's Bitcoin. That's what Bitcoin has become. It's become something to speculate on, a digital source of wealth. But as Powell points out and lots of other people point out, it doesn't actually do anything. I know someone will say, what about El Salvador? They're using Bitcoin as a currency, legal tender. Well, El Salvador is a banana republic. Half the population lives in the US. If you're in the US and want to send money back to your folks home in El Salvador, you've got to pay exorbitant bank charges and so on. Bitcoin is a way to do that. So it works maybe in banana republics, but I don't think it's the sort of thing that's going to take off as a currency in Australia. Maybe Ethereum becomes an underpinning of digital currency in Australia at some point, or Tether or something or other. Hard to see it for Bitcoin though, but it's just something to speculate on, and it does have that role as digital gold. And that suggests what could have more upside from here as it continues to take money away from gold. It's just worth noting that all the factors that have pushed it higher this year have nothing to do with fundamentals. They were to do with the advent of ETFs directly buying Bitcoin, the halving, and of course the optimism that Trump will be pro-crypto. That's not the same as NVIDIA, which has benefited from massive growth in demand for AI. So it's not fundamentally driven, it's just things that have excited demand around Bitcoin. So that should say, well, you need to be a bit cautious about this, but by the same token, I'm not going to deny that it can go higher from here, much like gold might.
All right, well, good to get your take, and that chart was I really thought that was interesting and puts it in perspective. So Shane, it would be remiss not to ask what you're expecting from this U.S. jobs report tonight. Will markets take it in stride? We again heard from Jay Powell, the Fed chair, who said they could move more cautiously on rate cuts going forward after that outsized 50 BP last time around.
Yeah, the problem with the jobs data is that the last one was 12,000 jobs. At the time, people thought that's terrible. Then they realised, well, it was a hurricane affected. So this one is going to see some sort of bounce back. I think the market and our expectations about 200,000. Unemployment probably stay around the 4.1% level, maybe edge up a little bit, 4.2. So it's, if you get that, people say, well, it's massive rise in jobs, but by the same token, it's distorted by what happened the previous month. And even if it came in at 300,000, you can put a moving average through it and say, well, it's still trending down. So I think you've got to be a little bit cautious about those jobs numbers. Perhaps the one to focus on is the wages number, which we think will probably show a bit of a edging down to 3.9%. If that's the case, and you've still got a broad downtrend in payroll growth, consistent with the downtrend we're still seeing in job openings and quits, even though they both rose in the latest month for October. If that downtrend is still in place, then I think Powell will probably still want to ease again next 2 weeks' time when they meet. But of course, before we get to that, on next Wednesday, I think it is, we get the CPI numbers, and they'll probably still show some elevated inflationary numbers in the US, and you might see that into year end, which may complicate things a little bit. But my take on Powell's comments is that he thinks there is a case to be a little bit more cautious. They don't need to cut rates as quickly as they have been, but I think they'll probably still ease in December. But as we go through next year, it's probably going to be every second meeting where they cut. Flip side, though, if you want to get excited about central banks cutting rates, you probably go to the ECB. They're probably going to cut 6 more times, a lot more aggressively, ultimately getting their cash rate down to 1.5%. Could be 7 times, I think, to get to that level. They've got a very different situation in Europe. The inflation numbers somewhat lower than they are in the US, and a lot weaker economic growth and political uncertainty, particularly around France, to contend with. So all of those things, I think, suggest that the ECB cuts a lot more than the Fed does.
All right. Well, look, it's been nice to catch up once again. I hope you have a great weekend. Stay cool out there, Shane.
I'll try. It might be a bit hot, steamy maybe as well. Anyway.
All right, take care. Shane Oliver, Chief Economist, AMP. Back to equities, and our stock of the day was Iluka Resources. Here's Dan O'Teasy from Stock Doctor and Luke Laretive from Seneca Financial Solutions.
I actually think the company has a pretty strong assortment of assets. It's just the commodity cycle is very much against them. They've still got a net cash balance sheet. And for the first time in a while, I think the valuation is actually pretty appealing. So I'm actually going to go on a buy on Iluka in today's news. I think the market's somewhat overreacted. And with a longer time horizon, like a 3 to 5 year view, I actually think this company offers really significant leverage to global growth, and particularly a recovering property market in China. So that would be the key metric to look out for.
I think there is some strategic value in Iluka, and I think the government sort of is, indicating that, saying, hey, they're a decent size employer. We kind of want to be part of this economy. We want to be part of this industry. We don't want to see these guys going out of business. But it's not really a good business to be in. So, look, I'd probably be more of a hold on Iluka at these prices, and maybe even looking to sell it if I did get the opportunity at slightly better prices. But you're right, Daniel's right today in saying, the market's given it a nice whack, so, maybe not the right day to be moving stock today.
Yeah, very clear calls coming from those two guests, wouldn't you agree? All right, let's go to some of the leaders and laggards today. I can't see any news associated with these, not material news anyways, but looking a bit better there for Lovisa, up by 2%, Web Travel Group up 2% to $4.84. Some of the laggards, well, we've got Iluka there, Magellan. FOS Capital is on my list, as well as Zipco. In the small to mid-cap space, we had some really good share price momentum behind, Bhagwan Marine, which was up by 24% to 70 cents. Tivan, oh my goodness. Yeah, Critical Minerals, future made in Australia, got some federal money, really sent the share price higher. Now, I know we've had a lot of people asking us to cover Tivan on the call. We will be doing so next week, and I've actually got a call in with the company. I'd like to speak with them myself. All right, flip the page, and we've got Orthocell. Look, it's been volatile. It had a big gain earlier in the week. It's off by 12%. 40S Memory down by 6%. Overnight tonight, that jobs report, we were just chatting with Shane Oliver about that one. We also got the University of Michigan Consumer Sentiment Index. Next week, all right, we've got the RBA decision, followed by Michelle Bullock speaking. We've got the monthly business survey from NAB, Combank's household spending insights, which will be important because this will encompass Black Friday. And just a good gauge of where consumers are at, really. We get also monthly employment data and population growth. Overseas, we get China, CPI, PPI, trade. It's the data dump. We get consumer price index in the US, as well as an ECB rate decision. So how did it all end up today? Well, we did see a lot of pressure coming through toward the end of the session. We saw the S&P ASX 200 shedding close to 0.6%, 0.64%, down 0.2% week to date. From all of the team here at AusBiz, we'd love it if you could catch up with what you may have missed throughout the week on our website, ausbiz.com.au. Also, just a reminder that the most recent edition of the Investment Committee is up online for you to watch if you've got a bit of time this weekend. Other than that, have a good weekend, have fun, stay safe, be healthy, and we'll see you on Monday.